Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 20 minutes or so. This week is going to be a continuation of the narrative about the retail consumer. Last week we had a lot of earnings. Home Depot did very well on Monday. They started things off and said that overall they saw a lot of strength. They had a really good quarter, but they do see that sales growth is waning a little bit. For some reason, that made that stock, even though they gave fairly poor guidance, that made that stock rock and roll, which also brought Lowe's, the duopoly, other company, up along with it. And now we're going to see Lowe's announcing earnings tomorrow. TJ Maxx announced, Walmart announced, all showing strength with the retail consumer. We saw the 10-year yields actually start coming down. The Fed came out and as far as the Fed fund futures, the futures contracts on the CME indicated that the odds of them raising at the next Fed meeting are basically zero now. And also the odds of a rate cut happening in March actually increased. All of this basically meant that the market was going higher, and the market has. We hit 4,500 in the SPX. We're up a little bit today in the S&P 500 index. We've seen the VIX come tumbling down. It's trading right around 13.7 is where the most recent quote was at. So some of the anxiousness of the marketplace is waning. Decent numbers from the retailers going into the holiday season. We have a few more that are going to be announcing besides Lowe's. We also have Best Buy, Kohl's. They're all announcing before the open tomorrow. But we have the big stock that I kind of had an epiphany on Friday, which is NVIDIA, one of the Magnificent Seven, probably at this point in time, one of the most heavily quoted stocks. Everybody trying to figure out what happened since the last quarter. And interesting enough, in NVIDIA, we actually, going into the quarter, which was another record quarter for them, the stock did go up, had a big spike up after their last earnings reports, only to get beaten all the way back down. And guess what? We're almost right back where we started at since the last earnings report. So we're sitting right around 500 on that NVIDIA level. We added NVIDIA to our deep in the money call position in the paper trading count on the TradeHawk software. We had a call option that expired on Friday, and we're going to wait for earnings before we're going to sell another one. So we don't really inside with the big leaf strategy, which means we're buying the deep in the money call option as a replacement for the stock, or a better word might be a surrogate for the stock. And then we're selling shorter term calls against that position. So it's a makeshift covered call, leverage covered call, some people will say. And when we look at that strategy, you're not looking to get assigned, and you want to be able to pivot quickly. So we're never really want to be selling or be in the covered call position around earnings. One of the biggest things about covered calls, and a lot of people get attracted to this, is the implied volatility that comes into the marketplace around an earnings report. So a lot of people that first find out about covered call writing, and they go and get a quote, and they notice, oh my gosh, look at all the premium that's in that quote. A lot of times, if it's too good to be true, it usually is. And a lot of people like to sell those calls, those expensive calls going into earnings, just because they look good. There's a nice yield to sell a pumped up implied volatility call option. But when you do that, you cap your upside and you still have all the downside of the call option. So the one time I don't really like to sell calls is usually around earnings. I would rather do even a collar situation if I was nervous about earnings, as opposed to just selling the call against that situation. A caller means that we would sell a call and use the proceeds to buy a put. So I want to have limited and known downside around earnings, and I don't want to cap my upside. So if I'm doing that strategy around earnings, especially in a situation where I don't own the stock, I own the right to buy the stock, which is a deep in the money call position, but I don't own it. So if I get pegged on the stock, then I have a situation where I have to unwind it and get out of that position. And that's not what the strategy is with the fig leaf. A lot of times when we're selling out of the money calls, we're doing it because we're either going to roll it, we're going to close it. We don't want to be called away on the position. Okay, so on Friday, I looked at the option that was going to expire and said, well, let's explore selling a call option, and realized quickly that, oh, by the way, NVIDIA is the last of the Magnificent Seven to announce earnings, and they're going to be doing this on Tuesday after the close. So we will eventually add some calls to our paper trading deep in the money call option portfolio. We're also going to look to add a retailer. We want to stay diversified in that portfolio. We're going to add a retailer. I've been looking at a few of them, haven't really decided exactly which one yet. Let's finish out this week's earnings. Tuesday, after Tuesday, there's a real drop off as far, I would say earnings season is over with, is the way that I would kind of approach it. There's always companies that are announcing earnings, obviously, but the bulk of them, the most explored earnings are basically done. Once we finish with the retailers, we do have Zoom actually tonight after the close, which that will be an interesting one to check out. But after Tuesday, yeah, it really drops off precipitously. So here we go. NVIDIA. So I decided today that I want to look at a speculative trade around NVIDIA's earnings. There's a lot of premium in it. And so let's run to the TradeHawk software, and we'll take a quick peek at what's going on in NVIDIA. First of all, let me start by pulling up the chart that I have in NVIDIA. All right, so just very interesting chart. Let me add some days so that we got a little bit better moving averages here. And I'm going to zoom in this section, basically from this gap up when NVIDIA really started taking off. So what has happened, this was actually right around their earnings. This was, I think, the gap up that we had. That would have been on August 29th. And then all of a sudden the topple all the way back down. So we went from basically a 100-point move all the way to the downside. So the lowest point since that last quarterly earnings report is down around that 400 level. But it is very interesting that we broke up above the 500 level. So we came up, we've tested that 500 level, which would be a new high in NVIDIA. And we've tested it again. Usually third time is a charm when it comes to bumping up against a resistance to the upside. But we have this earnings report. So obviously, if we can break through this, that's going to be a good sign as far as the technicals are concerned in NVIDIA. But a very interesting chart that we did all of this, and it says, oh, never mind, we're right back to 500 again in NVIDIA. We obviously have a big upturn here on the 20-day, crossed over the 50-day. It's good to get our ducks in a row, so showing a little bit more bullish market. And if we zoom back out, actually, and you look at the chart on NVIDIA, we're about 25% above the 200-day moving average, which obviously that's getting a little bit overextended. So, and once again, anything can happen here. A lot of news in the AI space today. There's a queue going on with OpenAI. So with that, Microsoft's it's just kind of a mess. NVIDIA is just sitting over here with these chips, looking for people to buy them. The demand is still there. They still have robust. The only reason why it's sold off the last time around is just because it's had such a strong run up. It's kind of one of those things, sell the news, buy the rumor, sell the news. And that really what drove NVIDIA lower. But yeah, if you haven't checked out the news between Microsoft and OpenAI, it's worth looking at. I don't want to get into too much detail here right now. It's not going to really affect what happens with NVIDIA and their earnings tomorrow after the close. So what strategy do we want to do on this? I think I want to go and get bullish on this. And as always, these strategies that we look at, they're not meant to be recommendations, especially around the earnings, because they're speculative in nature. But one of the biggest things about Options Guide TV is we have over 40 different strategies in the Options Playbook. And we like to look at times when it might be feasible to do a trade, to do some of these more advanced strategies that a lot of people don't often consider. So we're just trying to learn here on Options Guide TV. So if we can get a breakout to the upside, well, maybe we can get a little bit of a momentum. But this is definitely, like I said, this is the second time we came up and bumped up against that 500 level. And we see NVIDIA right now at 497.71. So we're just hanging there. This is definitely a line in the sand for that stock right around this 500 level. If we had came back down and bumped up again, kind of forming the head and shoulders pattern, then we'd be a little bit more interested in really getting bullish. We did kind of do that a little bit, but now we're bounced back up to that 500 level. So we're going to do a skip strike butterfly. A little bit more advanced. A lot of times we've looked at some butterflies around earnings, and a lot of that has to do with the premium. Butterflies, if you're correct on your forecast, wants implied volatility to come in. It wants it to go down. And that's the one thing that we are pretty certain of around an earnings report, that after the announcement, the implied volatility is going to come in. Most of the time that happens, we'll say 98% of the time or so. I'm sure there's a few times, can't say 100%, but there's a few times when it doesn't happen. So with that said, we're going to go above and beyond the 500 level. And the reason why we're going to do a skip strike butterfly is that we're going to bring in a net credit to the account, hopefully, when we look at that trade. And we're going to add some risk. So it's a little bit scary, because if we do get that huge gap up to the upside, well, we have some risk if it blows away the marketplace and it doesn't allow us to trade out. So the biggest risk is going to be a huge gap opening of more than a 1 standard deviation move. All right, so let's go check it out. I think this is going to be a fun paper trade to watch and to learn from this week. We're going to use the shorter term option contracts. We're going to do 4 days. Applied volatility is 90%. Once again, you look at November, you see that IV is trading here in the TradeHawk options grid, is trading at 90% for the November 24th expiration, 4 days away. Then we go out to the December, we see it 64. We go out to December 1st and then December 8th. Oops. Wanted to stay there. December 8th, we're 18 days, and then we're down to 55 now. So we do know that just confirms that we do have we have a big event that's going to be happening this week. At least the marketplace, the option chains are saying that. So over here on the left-hand side of the chains, we have the calls. On the right-hand side, we have the puts. We are going to go out to a 1 standard deviation move. So first of all, just quickly, let's see what the percentage possibility is around earnings. So we're gonna go 9. So we got 19 plus 19. If we just bought that at the money long straddle, and I'll put that in there. Let's buy it. Okay, so that's 38.78. 38 at the midpoint, 38.75. We'll call it 39. So 39 divided by 497.75. 497.75 equals 8% move, 7.8. So we're looking at about an 8% move in the underlying stock. That's what the expected move is. The marketplace is saying that there's no regard to direction, but I always think of it, especially around earnings, going out to this expiration using these option contracts 4 days away. that the expected move in the underlying stock after this earnings announcement could be about an 8% move or about 39 points. It never leans in any direction, up or down. So we want to make sure that we're further than that when we put this butterfly together, because our risk is to the upside. And then we can also go out and look at a 1 standard deviation move. So let me clear these out. So this is always where we start when we look at an earnings trade. Look at what the marketplace is expecting the move to be. To me, that's the over-under. If you are bullish on NVIDIA, you are hoping that it moves more to the upside. If you are bearish, you're hoping it moves more to the downside. Now, if you don't think that it can move that much, well, then you're taking the under. You're thinking that, well, this is a little bit overblown. So the marketplace sets the line at 39. You can decide, do you think it could move more than 39 or it can move less than 39? It's that simple. It's basically the over-under as far as any company is concerned going into an earnings report. Always important to note, though, that it is 4 days. A lot of people won't necessarily always just assume that it is only the day after earnings, but it's not. It goes out to that expiration date because you're using these option contracts. So you have some time premium in these option contracts that are part of the actual dynamics of the option, which is time value, as opposed to just implied volatility. Okay, so I'm going to clear this out. Let's get rid of those two. And now we're going to move out one inside the TradeHawk options grid. They have a very nice feature in that they'll shade where a 1 standard deviation move is at. And that delta should always be close to about 16, because there's a 16% chance of that stock finishing at least 1 cent in the money. And that's where we're at. And this is where we're shaded. So it's somewhere between the 545 strike and the 550 strike. That's right around a 1 standard deviation move. So I'm going to go, if we add 39 points to it, the 1 standard deviation move, which is quite often, it's going to be more than the expected move. That's just the way the math works out, and that's the way option prices are. It's all about math. So it's going to be more than the 1 standard deviation move. And we're going to go all the way out to this level, and this is where we're trading at. Now, one of the issues here is that this is way up, right? This is 550 on this underlying. And because of that, we really don't have any more strikes. This is territory where the stock has never been at. So that's going to kind of affect the trade. Now, if we went out and looked at the actual expiration in December, we might have a little bit more trades. I think that's going to be December 15th. I think that's the 3rd Friday. Let me just double check that. December, yep, that would be the 3rd Friday, December 15th. And then you may get some more, what would be the word? Some more strike prices that would be available. But we're in new territory. So an issue here is when we're doing this trade, we can't go as far out as we'd like. It's that simple. So we're buying, in this instance, the 550 strike call option, and that's got some value in it. As we go through all of these, that's still got $3.55, and it's only a 1 standard deviation move away. So here's the trade that we're going to set up. We're going to start by looking at about. We wanted to get to about 540. We're going to try to do this 10-point expiration. And I think, you know what? I think I'm going to alter it a little bit. Let's look at buying this one, sell this one, and we're going to view this a little bit because of the strikes that are available. So that's 10 points. And let's make it a ratio butterfly. Okay. So we'll buy this one. Oops. Buy the 530, sell the 545. We're going to do that twice. And then we're actually, let's do that 3 times. And then we're going to buy the 550 on the ask. Too much of a credit. Okay, let's keep it there. Okay, so the credit on this trade is $3.25. And oh, we got to buy 2 of these. That's why it's too much. Okay. And here's the ask. Okay, so now we're a net debit of 22 cents. All right, we're going to ride with that. Okay, so now we're going to make this butterfly. It's going to be fairly inexpensive. We're going from 530 to 545, but we have 2 spreads that are paying for our 15-point spread here in NVIDIA. We're doing this for a net debit of 22 cents to the account. It's trading, let's do 30 cents right at the midpoint. And let's look at how this looks in the what if calculator. So here we go here, send it to the what if, and we're going to add a little bit more risk than the traditional butterfly. We're going to pay a small net debit to the account, and we're going to skew it on the way up. Okay, so the marketplace thinks that we can move 39 points. So we're at this point in time, we're at 496 plus 39. That would be 535. So this is where the marketplace says the expected move is at. The 1 standard deviation move is right around the 550 level, right? Yep, 550, 545, and 550. That's right where that 1 standard deviation move is at. So we're saying it's about a 1 standard deviation move to the upside. We're going to sell 2 of these spreads right here to pay for this 1 long spread. So we changed it up a little bit, and we're going to do what's called a Christmas tree butterfly. It looks like to me like a Charlie Brown Christmas tree. And I might, since I've changed it up a little, let's go in and actually show you this inside the Options Playbook. So let's zoom out for a second here, if we could. So we'll zoom out and we'll come in and let me adjust my screen. And let me show you what the difference between a Christmas tree butterfly and a skip strike butterfly is. Okay, so this is what a skip strike, or some people will call it a broken wing. I don't like broken wing because I don't think it's descriptive enough. It's just a name that came out. They're saying it's a broken wing butterfly because they're saying the butterfly has a broken wing. Skip strike means you literally skip the strike. If it was a standard butterfly, you'd buy the A, sell the B, buy the C on the strikes across here. But in this butterfly, to make it a skip strike butterfly, is you literally skip that strike. And when you do that, you effectively put in a short spread from strike C to strike D. This one you would sell, this one you would buy. That's normally, when you do that, that brings in a credit, obviously, to the account, and it adds more risk. So the goal with the skip strike is to make that credit pay for the standard butterfly. But what's beautiful about that is this: if the market goes down, if you can get it done for a net credit, you actually don't lose any money if the market goes in that direction. You add risk here, you remove risk here. Okay. Christmas tree butterfly, which we're going to look at here with calls, and this mainly was forced by the strike prices, to be blunt. But what we're going to do is we're going to make the long side of the butterfly longer, wider, if you will. So in this instance, we're skipping basically strike B. We're buying strike A, going all the way to strike C. So this is a long call spread. And then we're going to double up and we're going to sell 2 short spreads from strike C to strike D. So now we're getting a more expensive long call spread, but we're going to sell 2 short spreads to pay for it. In our instance, we're going to have to pay a small debit of about 22 cents to put this trade on. But in this instance, we're going down a little bit. We're going to add a little bit more risk. So this is a little bit even. Our goal was to try to do this and try to get it done for a net credit. We didn't quite get there, though. So if we'll run back to the software, this is kind of the profit and loss graph, and we'll look at the real live trade in the what if calculator on the TradeHawk software. So here we go. Let's go back to here, and we'll switch things back up. Okay. So we're back. Okay, so here's the way the trade works out. Notice we have a very, very little risk. If the market goes anywhere this way, we lose a quarter. We lose 25 cents. That's simple. Market comes up here. We have a long stretch where we can make money because we have a very long spread in our butterfly from 530 all the way up to 545. Then we add a little bit more additional risk. So on the downside here, though, we did 2 of these short spreads. So if we get all the way down to here, we can lose 535, but that doesn't kick in until we get to about right here. By the expiration date, our break even looks like it's going to be around 552. Let's call it 552.50. All right. We'd have to do some math to be able to get it exact. So 552 is about where our loss starts kicking in on this trade, right where we're crossing this x-axis to be able to find that exact point of that break even. All right. So this is going to be our official paper trade. We're going to do this butterfly around NVIDIA around earnings. So we're looking to buy to open the 530 strike call, sell 3 of the 545 strike calls, and then buy 2 of the 555 strike calls. Important to note that this is a 1 by 3 by 2. If you look at the options that we bought, if we buy 1 of the 530s, we're also buying 2 of the 550s. 1 plus 2 adds up to 3. And hence, that's why we don't have unlimited risk. We have just as many long options as we have option contracts that are bought or that are sold. Just as many long options as we have sold short options. And that caps off our risk on this trade. Looks like a net debit. I'd like a quarter. Let's grab that quarter. Let's make it 25 cents just because it's fun. It's a quarter. And we'll see what happens. NVIDIA is going to announce earnings. Now, normally, as we look at this, normally we would do this closer to the earnings report, but we're doing Options Guy TV here on Monday. We don't have a show on Tuesday. But with that said, this is the way that I would set this trade up based off of what was given to us with where the option chains are at, what a 1 standard deviation move is at. This gets us right at a 1 standard deviation move. It limits our risk. I'd like this to be a 5 or 10 cent credit, but we couldn't quite get there. We're at a 25 cent. I'm okay with that because we have 15 points of upside from 530 all the way up to 545. Expect implied volatility to come down. If we do this trade and you see this thing and we can close this out and bring in a couple $100 on the trade, we're going to do that. We're not going to try to hang around and make the maximum on the trade, which is 15 points here from 530 to 545. If it went out right at 545 at expiration, that would be our upside. So if we get to profitability, if it gets somewhere around that 530 level on the open, about the expected move is approximately where that starts kicking in, then anywhere in this range, we can close it out. That stock is trading within that range. And that's the way we're going to approach it. I don't anticipate going into earnings that the stock will actually break up above 500. If it did, that would be really interesting. But I really think it's going to take earnings for it to try to break through that resistance to the upside. And we're right at time. So do we have any other questions? I forgot to ask for questions, but if you have them, you know to put them in the chat box. We're very interactive here on Options Guy TV. And if not, we'll come back on Wednesday for the next edition of Options Guy TV at 11 a.m. Eastern Time. Please click subscribe and ring the bell and pound that thumbs up. It really helps us out a lot. And we'll see you this Wednesday for the next edition of Options Guy TV. Thanks for coming, everyone.